Okay, so I've been investing in the silver, precious metals, and resource space for, well, I'm going to say easily over 20 years, probably 25 years now. And especially in particular in silver and gold, going back for sure about 20 years. And actually, as an analyst, working as an analyst and writing newsletters, researching companies, you know, building contacts and leveraging those contacts for the last 15 years. And about 4 years ago, and this was kind of right at the near sort of the beginnings of COVID. I had been in a previous um, uh, I guess setup where I was writing a resource newsletter. That company ended up folding, and I was twiddling my thumbs for a little while, and I said I've got to get back into this, and reached out, connected with Gwen Preston, actually out of Vancouver, who wrote Resource Maven for several years, almost, in fact, 10 years. Reached out to her in 2020, and we hit it off within a few months, had my silver newsletter up and running using her I guess, back end of her website as sort of the support for that letter. And the letter has grown well. Within a year after that, I wrote my book, published that 3 years ago. Very happy with the response from that. It's been a bestseller. And then just this year, beginning of this year, started a second newsletter called Silver Advisor. And that is a free letter that follows companies that are a little bit, I'm going to say, typically more advanced. They can still be juniors, they can be explorers, and they can be producers. But that's a little bit of a different model. It's meant to be a little bit more introductory to people who are following the silver space. And that's gone well. Started that in January. We're up to, I think it's 7 companies already that have joined that letter, and seems to be continuing to grow really well. So I'm all about trying to be educational when I talk about silver. I want people to understand the space, and that's really why I wrote the book. The book really is what I would call an overview of silver and what I call a generational opportunity in that metal and in the equities, the stocks around silver. And the newsletters, so I've got a paid newsletter, a subscriber based newsletter, and then the free one. And those are the ones that are what I would call more sort of real-time analysis and following what goes on day to day in the silver space. And so, there's multiple options there. If anyone's really looking for a good intro, I think the book, and that's the kind of feedback that I've gotten, that the book gives a good overview in terms of silver, but also I went into some macroeconomics, and I really wanted people to understand where I was coming from and where I think things are going. And, it's interesting. I wrote that 3 years ago. A lot of what I have in there has sort of started to play out in terms of, where the world's going, where finance is going, interest rates, stock markets, precious metals, all of these things, alternative assets, where all these are going. We sort of start to see that play out quite a bit. So that's quite rewarding for me, and certainly, helps to bring some credibility to my message. Well, it's always fun talking to you, Callie, and I do find that you have a great way of sort of boiling things down simply for viewers and listeners. And so I'm glad to be part of this today. My talk is Silver, a Generational Bull Market, and I've kept it, I'm going to say, at a relatively high level in terms of the opportunity, what's going on in economics and finance globally, to explain why silver is a something you'd want to have some exposure to, and then I get into silver more specifically, the fundamentals of it, and where I think we're headed. So, big picture, I see 3 big risks that I think investors really need to bear in mind right now. I think inflation is not only going to persist, but it's going to come back and trend higher. The best analog we have is the 1970s, and sort of late 60s, mid 70s, and then late 70s. There were 3 successive waves of inflation, And each time inflation came back, it came back even stronger. And I think we're at a bit of a lull right now, and that inflation is probably in some way sort of bottoming, and that we can expect it to start to trend higher again, probably within the next sort of couple of quarters or so. Now, economically, I think that we're also stagnating. I think that economies, the economy globally is struggling, and that kind of combination where you have inflation and sort of weak economic growth is what we call stagflation. So you have the stagnation and the inflation at the same time. In the 1970s or prior to the 70s, economists, well-respected economists, saw this couldn't happen. Like you couldn't have that kind of combination. And the 70s proved them wrong. And I think that's exactly what we're heading into again now. The other big risk is that I think stocks and bonds are at the beginning of a secular bear market. I have some data to show you, some charts, especially on the bond side. And then the third one is the US dollar. Now, I think most currencies are going to get weaker, especially relative to commodities and precious metals in particular. But I think that the U.S. dollar, which is obviously the de facto world reserve currency, has seen a peak, a recent peak, and that we're going to start to see it weaken. And with all commodities priced in U.S. dollars, that means that the prices of those commodities are going to continue to go up in dollars. I'm going to try and move it along here. So this chart on the left shows us inflation. Now, the U.S. Fed looks at a particular measure of inflation. They call it the core PCE, a personal consumption expenditure. And this chart shows that it's been trending up. So if you can see here, this goes back about a month or so, and it really has started to trend up. The Fed says that their target is 2%, as you can see this blue dotted line, when in fact, right now we're actually right around 3.5%. That's a long way from 2%, and it's certainly not going in the direction that the Fed says that they would like. We also see, I was talking before about stagflation, so the stagnating economy. Q1 this year, now that was for sure impacted by this whole tariff talk and so on, and companies building their inventories, and sales, of course, being weak overall because of concerns of what the outlook is. But we had the first negative quarter GDP growth in the U.S. In about 3 years, so that's quite something to note as well. 1 year inflation expectations. I think that the population at large is really, really starting to clue into the fact that inflation not only is here and not going away, but heading higher. This is really, really kind of almost shocking to me. Even University of Michigan does a lot of great research on consumer expectations and inflation expectations by U.S. consumers absolutely exploded in the first quarter or so of this year, going from around 2.5% to 6.5%. That's what they think inflation will be over the next year. And that is a level that consumers haven't sort of been expecting or predicting since the early 1980s, actually 1981. So bonds, the bond market. Bonds are struggling because interest rates are heading higher. So if there's one thing that you need to know about bonds is that they move inversely to interest rates. If interest rates go up and bonds pay interest rates, that means that the bond price has gone down. So this is a chart of an ETF. So it's kind of like a mutual fund of bonds, and where it's 20 years or 20 plus year maturities for US bonds. And you can see that since sort of early mid 2024, we've had it's kind of dropped, moved up, dropped again, moved up, and then dropped again. It's actually risen a little bit to 86. But it looks like if it drops below sort of the 83 level, or 84 level, the price of this ETF, we could be easily in a renewed bear market, sort of near term for long-term bonds. So that means that people want to sell their bonds because they feel that interest rates are going up. So those bonds they have that pay a certain rate of return become worth relatively less because you can get higher rates on new bonds. This shows with the 30-year US yield. So in other words, how much US 30-year bonds pay in terms of interest. So this is really, really interesting to me because that blue line shows that since about 1981 or 1982, so 40 years, interest rates were falling. That is a huge bull market for bonds. And it also really tells us that we've experienced an entire generation, really, of investors who've known nothing else except falling interest rates. And so when interest rates go down, as I mentioned earlier, you have the inverse relationship. So bond values go up. And that actually had a dramatic bottom in early 2020 when COVID hit. As you can see down here, it rose again, and it's actually broken out now above that falling resistance line, as we call it, that blue line. And so rates, as I say, rates fell for 40 years. We've had a breakout. If you look at the bottom, where the level of interest rates when they bottomed in early 2020 and where they are now at about almost 5% on the 30-year bond, that's almost 11 times higher than where they bottomed about 5 years ago. Again, at the beginning of COVID. So we're in a new interest rate environment. In the US, they're out of a $36 trillion debt, $9 trillion of that, so a quarter of it, is going to mature this year alone. So what is going to happen when the US Treasury has to renew all of these bonds? And renew them at much higher interest rates because, as you can see here, interest rates have gone up so much. So the answer is that they're going to have to print more. The money isn't there. The deficits and the debt are growing, and so the only way that they can actually manage to pay higher rates on these bonds that are coming due and being renewed is to print more money to pay the higher interest rates. This is quite something. I'm saying downgrade America. Well, there are three large bond rating agencies in the US: Standard and Poor's, Fitch, and Moody's. And this was almost something that was sacred. You'd never, ever, ever in your lifetime expect that US rating agencies would downgrade US debt. It was just, sort of the gold standard. Nobody would question it. US debt was rock solid. And yet, in 2011, Standard and Poor's was the first of the big rating agencies to downgrade. That was right around the time that there was this issue with trying to raise the debt ceiling, which comes up every sort of year or two in the U.S. And gold rallied dramatically. It reached around $1,900 at that point. And in any case, Standard & Poor's downgraded the U.S. debt. We had that happen a second time by Fitch Ratings back in 2023. And only very recently, I think it was last month, Moody's for the first time, and is the third of the three big rating agencies, has also downgraded U.S. debt. And they're citing the U.S. deficit and the requirement for rising interest payments, which I just described earlier. So this chart is U.S. 10-year treasuries, and it's provided by Bloomberg, and it shows you that investors are starting to demand extra yield to hold long-term U.S. debt. And as I say, the reason for that is because interest rates are going up. They know that There's going to have to be a lot more money printing, so more inflation, less value to the to the circulating dollars out there because you're simply printing more and watering down the value of the existing ones. And because of that, investors are demanding higher returns on U.S. long-term debt, meaning they're pushing the value of those bonds down. So beware of investing in bonds. I would suggest, not holding anything that has a maturity of anything longer than about a year or 2 years. You do not want long-term U.S. debt. Odds are it's going to continue to lose value, and I think we're in a secular bear market for bonds. Talked about the US dollar before. I think that we're in a new secular bear market for the dollar. If you look back about 40 years, 30, 40 years, the US dollar index, which is the dollar valued relative to about five or six other major currencies, it had a peak in the sort of early 90s, early 80s. It peaked again in the early 2000s, and I believe it peaked again about a year or so ago, and that we're headed lower. So I think that we're going to see the US dollar index in a range somewhere between about 80 and 95 or so. I do think it could rally a little bit here, bring, in the next sort of week or couple of weeks, maybe a month or so, try to get back over 100, but I don't think that's going to last. I would expect the dollar to get weaker. It moves in multi-year trends. We know that Trump wants a weaker dollar. That's exactly what he got when he when he was president the last time around 4 years ago. I don't see why it's not likely again this time. But what happens with a weaker dollar? Well, you see capital flee U.S. Treasuries. You see capital flee U.S. stocks. A weaker dollar, causes deficits to persist and get even worse, which means more inflation. And a weaker dollar, as I mentioned earlier, is good for precious metals because commodities, precious metals are priced in dollars, and they outperform. So it takes, as dollars get weaker, it takes more dollars to buy a given commodity, more an ounce of gold, an ounce of silver, and so relatively, its price goes up in the dollar when it gets weaker. Now, switching gears a little bit, I want to start talking about precious metals themselves and then silver in particular, but I thought this was a really, really interesting chart. And this is a survey of family offices. This is mostly data provided by UBS Bank. And now family offices are really offices that manage the funds for rich families, basically high net worth individuals and families. And so they're quite sophisticated, and they will diversify into all kinds of asset classes in order to minimize risk and so on. And what I find interesting is that even family offices, as of 2023, hold less than 1% in commodities and about 1% in gold and or precious metals, meaning silver, perhaps some platinum or palladium. But that's really very, very telling as far as I'm concerned. It means that the exposure by even the smartest money, amongst the smartest money, has almost no exposure to gold and silver. I thought this was kind of interesting. I just produced this a little bit earlier today. And so what I did was I compared some major asset classes. So we have gold, silver, the S&P, the NASDAQ, the US dollar index, and the 20-year Treasury bond ETF. Well, if you go back from the beginning of this year, gold is up 26%, silver is up 16%, almost 17%. The NASDAQ is barely up 3%. In fact, it was negative until about a month ago. The S&P, same thing, but 1.7% on the year, was negative about a month ago. The 20-year Treasury bond ETF is down on the year, down almost 3%. And the US dollar index is down 10% on the year. So clearly we see there is an emerging trend of gold and silver that has been outperforming some of these other major more well known and more widely owned asset classes. This is an also very interesting chart that compares gold, silver, and the S&P going back to 2001. And I'm willing to bet that if you asked most people right now, um, what's been the best place to be invested for the last 20, 25 years? They'd almost invariably say, well, the stock market. It's been strong, it's done well, and it has been in a bull market overall since 2000 or so. I mean, did struggle at beginning of 2000, 2001, and then again you had the financial crisis, and you had some bumps along the way, but otherwise it's done relatively well. Silver is up about, I believe that's about 650%, where the S&P is up about 350%. So silver's up almost double what the S&P is, and gold is up about, my numbers are a little fuzzy here, but I think it's about 1,700% since 2001. So precious metals have totally whipped the S&P, and of course, they've had more volatility, but easily, handily beaten stocks. Now, this, for comparison purposes, shows you silver and gold and the S&P and the US dollar index during the 1970s. So from the late 60s until about 1980 when you had gold and silver peak. Well, silver was produced a 2,400% gain. Gold produced an almost 1,600% gain over that decade. The S&P was barely up. If you account for inflation, it was completely flat. Otherwise, it was up 56%. The US dollar index was down 24%. I think we're in this kind of environment now. I think we're probably somewhere around maybe here, and that we've got sort of we're in the sweet spot where we've got the best gains still ahead of us. And so now, more specifically, silver. Silver, in my view, is extremely undervalued. There's a ratio called the gold-silver ratio. I'm going to get into that in a second. But right now, it's completely out of whack. Silver is very, very much cheaper than it is traditionally, historically, against gold. And so it's a true bargain right now. And interestingly enough, UBS just a couple of months ago told investors that they should buy silver through this Trump tariff turmoil. So that's not something you see from a large bank every day. Silver is very interesting because it is so sparsely owned. In fact, right now, less than 0.03% of global wealth is in silver. It was not even 0.1% of global wealth when it peaked at $50 in 2011, or even, let's say, averaged over $30 in 2011. So it's extremely under-owned, and I think that means that it has tremendous upside. When people start to understand and come into this space, see it move, and really want a piece of the action, that's just going to drive it tremendously higher. Now, if we look a little bit at some fundamentals, I'm talking about supply of silver from mines. This is a chart that shows that mine supply of silver peaked back in 2016, and it has actually been dropping considerably on balance. Last year so in 2016, we had 900 million ounces from mining. Last year, we had about 837 million ounces. Forecasts are that we're going to continue to see silver from mining. Most of silver comes from mining, some comes from recycling. We're going to see silver from mining continue to struggle for the next several years. In fact, the Silver Institute thinks that we're going to see record deficits in the supply-demand balance. So that's really very, very bullish for silver fundamentally. Now, this shows the silver market balance. So it tells you that since 2021, and with a forecast for this year, that we will have 5 consecutive years of deficit in the silver market, meaning we are consuming more silver than we are bringing to market. And as I say, about 85% of silver comes from mining each year, and about 15% comes from recycling. So the silver market every year is about 1 billion ounces, and yet we're actually consuming 1.2 billion ounces. So we're 20% consumption above supply. And, the question comes up often, well, how can you possibly be consuming more than you're producing? It's got to come from somewhere. And last year, I dug into this pretty deeply and figured out that really where the silver was coming from to meet this excess demand was from we have what would I call secondary inventories. These are stockpiles of silver that already exist. They're sitting on futures exchanges, financial exchanges. You have private holdings of silver, private hoards of silver. And so the big consumers of silver, especially the industrial consumers, because silver is widely used in all sorts of things. The big one these days is solar panels, which by itself, by the way, consumes 20% of all of the silver that we produce every year. Um, those big consumers of silver have been able to go to these secondary stockpiles, buy silver that did not need to come from new mine production or from recycling, and get the extra silver that they needed that made up this balance that you see, in the last 5 years each year. But those stockpiles are draining and they're running out, and those supplies are getting very, very tight. So the only way there is still quite a bit of silver that's owned privately that we don't have numbers on, probably a few billion ounces, but I think that that silver will only come to market when silver is at much higher prices. And so that I think is going to help to drive the silver price higher. I talked before about the gold silver ratio. So really what this is, it's a simple comparison of the gold and the silver price. And what it tells you is given the price of gold and the price of silver at a very specific, at a point in time, any point in time, uh, it tells you how many ounces of silver you need to buy 1 ounce of gold. So if, for example, silver is at $32 and gold is at $3,200, then you need 100 ounces of silver to buy 1 ounce of gold. Now, this is abnormal for the ratio to be at 100 and to even be over 80, frankly, for any kind of an extended period of time. The average of the last maybe 40, 50 years is closer to about 60 to 1. In other words, it would normally take about 60 ounces of silver to buy 1 ounce of gold. And what we've seen is that when the ratio gets to 80 or above and then starts to fall, which it typically does, in the sort of mid 2000s, we had that, it went to 80, it fell. We had that late in the 2000s, again, it went to 80, it fell. That's more typical. When it gets to 100, it typically does not stay there all that long and starts to fall. When it reaches 80 and continues to fall through 80, then you can pretty much be sure it's going to head somewhere close to about 50. When we hit COVID, there were all kinds of commodity prices that were out of whack, and the ratio of gold to silver actually went to 120 to 1, something I think historically has only been seen one other time. And right now we're still at about 100 to 1, so it's very, very bullish for silver. Really what it tells us is that silver is very, very cheap relative to gold. And if you were to consider, let's say, a $3,200 gold price, and that the ratio would fall to 70, that would mean a $45 silver price, which is about a 40% gain from where we are right now, just in the price of silver. So I think, again, very bullish looking for silver. This is actually a chart produced by Incrementum. It was something that I came up with actually originally, and I was curious to see how silver behaved when the Fed starts to cut interest rates, which it did last fall. And what I noticed is I looked at the last 3 times, the last 3 cycles. So the last 3 cycles were in the early 2000s, and then in 2008, and then in 2020. And what I noticed is that Silver starts to pretty much take off when the Fed is about halfway through its rate cutting cycle. So if you look at here, it started to cut here, and then it more or less, did most of the cutting by the time it got here. So around the middle of that rate cutting cycle is where you see silver start to take off. Same thing happened here in 2008, 2009. Same thing happened in 2020. And the average gain over the next, say, 6 to 12 or 18 months after the Fed starts to cut rates and are in about the middle of the rate cutting cycle and silver bottoms and starts to rally is about 300% gain in the silver price. So I'm very bullish. I think we are here somewhere. The Fed arguably may still hold rates higher for a while. They are going to start cutting. Once we get some more economic pain, they're not going to be able to resist. They're going to resume cutting, and that's going to, help, or they think it's going to help. They're hoping it's going to help, boost the economy because borrowing becomes cheaper again. And but lower rates are very, very positive for precious metals, gold and silver, because they don't pay a yield like bonds do, or even some stocks. And so, since they don't pay a yield, when rates are higher, that competes with them. If short-term rates get cut, that makes gold and silver more attractive, and that's typically why silver rallies quite strongly in rate cutting cycles. This is an interesting chart. It's from a colleague of mine, a very respected technical analyst, Jordan Royburn. He writes the Daily Gold. I think his work is fantastic. And what he did was he looked at how silver behaves when you have gold reach an all-time high and break out. And so the bottom line is that what you need to understand from this chart is these green and purple and gold lines, and even the blue one, show us the last bull cycles of when you had gold rally, break out to a new all-time high, and then continue higher. The dotted line is the average of these different breakouts. This solid black line is actually the current bull market for silver, which started around the end of February of last year. So it shows you that we are very, very, very early in this current bull rally, bull cycle for silver. In other words, if you look at just the average of where silver went when gold hit an all-time high and broke out, you could argue silver could more than double from here with no problem and hit somewhere around 70, maybe even $80 an ounce at some point over the next maybe year or so. So very, very bullish. I'm not saying it's going there and doing that, but I do think that next year we're going to see a breakout well above 50. And so 50 is an absolute key number for silver. Reason for that is, and this is just nominal, we're not even accounting for inflation, but silver's all-time high was $50 was first reached in January of 1980. And then you had a very, very, very long period that lasted 40, 50 years. And silver only touched almost $50, say $50 back in 2011. That would have been April of 2011. It then proceeded to correct again pretty significantly. Now we're around $32, $33. I think 35, 37 is going to be very significant in terms of breakout. And then, but certainly $50 is the absolute big key. It's never been above $50. And I think once we see that, we're in uncharted waters, and you could certainly see tremendous excitement. And I think that you could see silver rally very quickly to $70, $80, maybe even above that. So something to watch for. The silver mining industry is absolutely tiny. I mean, if you look at this green dotted circle here, it shows you that this, if you add up all of the silver miners, you're talking about $25 billion market cap in total. If you add up all of the gold miners, you're at $647 billion. So it's something like 4%. The silver mining industry is about 4% of the gold mining industry for public companies. And you compare that to Apple, somewhere around almost $3 trillion. So this is a very, very small space. And when a lot of capital starts to flow into it and there's tons of value there, that really it gets it moving quickly. Now, this chart shows SIL versus silver. SIL is what we call an ETF. It's kind of like a mutual fund, and it owns a whole slew of silver mining companies. It's not a perfect proxy for silver equities because there are some gold miners in there and so on, but it's a pretty good one nonetheless. And so what we see here is that this is the SIL ETF versus the silver price. And when this chart moves up, what it means is that the silver equities are gaining faster than the silver price. They're outpacing the silver price. And there's been this long consolidation period since 2023 up until recently. We've started to see it move higher, and now we've actually seen a breakout in the SIL ETF. So these are sort of larger size companies that are really, getting a lot of attention, investor dollars, and are pushing higher versus the silver price. And that means you're getting leverage over silver, and it's very, very bullish. This one is, if you look at, sorry, that's a slight mistake I have here. This should read SILJ. So it would be the Silver Juniors ETF. So smaller silver companies versus the silver price. And they have not yet had quite the breakout. They need to reach a little bit higher versus silver before they can outpace and see real sort of potentially sustained move higher. But it's been a strong move actually since the last few months. They've really, really started to trend higher. And so it's looking very bullish for junior silver miners versus the silver price. Whoops. Again, a chart from my colleague, Jordan Roy Byrne. What he did was he looked at previous bull markets in silver junior stocks and showed where we are today. So there have been several. There have been 4 or 5 others, and yet the black line is where we are right now. So it's kind of hard to see, but so what I did was I put an arrow and a circle around it, but this is the very spot where we are. So if you compare even to, let's say, an average of the 3 sort of stronger ones, we are probably only about a third of the way. So silver stocks could basically triple or quadruple from here, and you'd only have sort of the average of the last 3 junior silver stock bull markets. So again, tremendous, tremendous upside built in here. And once we see this move happen, expect a lot of money and attention to start flowing to this space. And it's just going to be gangbusters. It's going to be breathtaking, frankly. These charts show what happens and what it can do and has done. If you look back to the bottom in the silver miners ETF, that bottomed in February of last year, late February. It's already up 95%. So you may be saying, wow, so I've missed the boat. It's already up 95%. It has nearly doubled. But look at this chart. That's the same ETF, but over a longer time frame. So this only goes back a little over a year. This goes back about 10, 15 years. And what it shows us is that this spot is where we were last February when things took off. And this is the 95% gain from last February. But we are just barely getting close to just breaking out, to being able to show that, silver miners, based on where the highs that they hit in 2020 when COVID hit, that was a tremendous time. And then in mid 2016, also a tremendous time. We're getting very close to that again. And so that should, the 95% gain from last February shouldn't discourage you. We have a long, long, long way to go in silver mining equity prices. One of the last things I want to talk about is seasonality. So this is typically an average of what silver prices do throughout the year. They start at the beginning, They rally for about the first maybe 4 months or so. Then they move downwards for about 2 months. So that's May, June. And then typically they tend to bottom in June. So the month of June is sort of the weakest month. We haven't really seen that so far. We're only a few days in, but it's possible we may get, some more, a little bit more weakness. But typically, silver will bottom right around the end of June, and then the rest of the year is just very strong. You get a bit of sideways movement in September, and then some strength again. So this is the second strongest part of the year is about to come and could start anytime. So just to give you an idea of the kinds of returns that we've produced in the newsletter, we've got 5 companies as examples here. One is a large tailings project. That means treating ore that's already being mined. It's above ground. That company was up in about 4% within 5 months. And then you've got this other large British Columbia company that's advancing towards developing a big gold silver deposit. That's already up 45%. It only took 2 months. One silver junior that has over 300 million ounces of silver equivalent and a huge and growing resource. I recommended that back in, I think it was March of last year. It's up 170% in just 14 months. Another large company with a large silver resource in Argentina, a growing resource, that's up 131% over the last 13 months. And one Mexico high potential explorer was up 134%. It was recommended in, I think, December last year. It took 2.5 months and it was up almost 140%. That gives you an idea of the kinds of gains that can happen in this kind of environment. And these are real gains. These are very recent, and I think that there's just a lot more of that to come right now. Just to explain a little bit, my Silver Stock Investor newsletter, the paid letter, I really talk about all things silver. I talk about everything from physical silver all the way down to junior explorers. And the recommended companies in that letter include things like ETFs and physical silver ETFs, mining ETFs, and then big companies that are royalty companies. They get paid for every ounce that companies for projects that they hold a royalty on in silver, large silver producers, growing producers, and explorers. And then I give my thoughts. It's a weekly letter. I give my thoughts on the macroeconomic landscape. I have some proprietary research on silver. Every time I recommend a new company, I give a full analysis, and I update all material news on the companies. You can, find more information here at silverstockinvestor.com. As Callie mentioned at the beginning, I'm on Twitter or X and LinkedIn. And the book, The Great Silver Bull, you can find it on Amazon in different versions. And I just think it's, a great way to get an introduction to silver and the opportunity in silver. So there we go.
Peter, thank you. That was amazing. We have a lot of questions.
Okay.
I'm going to try to start at the top.
Sure.
Would you say near-term producers, especially juniors that are fully permitted and funded, offer the best risk-reward profile in a silver portfolio today compared to a pure exploration or major?
Yes, I would say that's a very, very much a fair statement because one, there aren't that many, and two, fully permitted is a tough status to achieve these days. And when you have a scarce commodity like this that is in huge demand, it really and there are so few quality companies in the silver space. I mean that this is what I spend my time doing is looking at what I think are the best companies across the spectrum, everything from explorers to all the way up to producers and so on. And obviously, I want to recommend the best. I invest in on all of the ones that I write about. I want to recommend what I feel is the best. And I can tell you that the space is not only small, but getting smaller. We had last fall, and I had been telling people from the beginning of last year, we're going to start to see a lot of M&A in the space. We're going to see companies buying each other out, buying their projects, combining, and so on. We had 2 big M&A deals at the end of last year. So that meant, in other words, two great companies kind of disappeared in a sense. They didn't really. I mean, they got folded into an existing company, but your choice in terms of who to invest in shrank, right? And then we had more news of that again earlier this year. There is Pan American Silver that is making a play for Mag Silver. And I can't be specific, but companies that I speak to, one in particular that is a very interesting pure play silver producer has told me that they're getting calls, regularly, and they want to, other big producers want to do site visits, and they're telling them, all our information is available publicly. We're not going to go out. We're not going to, go out to site with you and so on. You want to go, that's one thing. But anyways, all that to say that the market is heating up very, very much, and I think that that's a great point by that listener or viewer, is that yes, in terms of risk reward, you've mitigated a lot of risk because you've got all of your permits, and yet you're not yet in production, and so your potential upside, I'm assuming that depending on the project, that there's probably good potential to grow it as well, especially if it's high grade, it's even more attractive. If it's in a good jurisdiction, it's again more attractive, but fully permitted is fully permitted. And unless something happens, specifically to that project, then the outlook should be pretty good. And I think that's a fair statement.
There's another question similar. So I feel like you kind of answered part of this, but are we talking about like a handful of companies that are in this fully permitted silver project that's actually ready to go or close
Yes.
to production? Or
So I would say it really, really is a handful that are fully permitted, or just waiting on sort of one small thing. We're talking about probably a matter of months. There really is just a handful of companies like that, and it's fair to say that the rest of them sort of the next sort of best setup is you're looking at maybe a year and a half to a couple of years. That's sort of the next stage, and then others are multiple years away because they may have found a deposit. They're probably spending a lot of money drilling and growing the deposit, which is great because they're making it more valuable as we go. But permitting will take a while. So some of those great projects that may have 50, 100, 200 million ounces may not see production for 4 or 5 years easily. So,
they ask for examples, but if you don't feel comfortable with that, how many examples would you have in your newsletter if someone reached out to you?
okay. So, well, what I would say is that, so what I can say, I can give some answers to that, because in the paid letter, how many companies there would be in that sort of, are we talking about the ones that are permitted, or just in general? Just I can give a number for each group perhaps. So the ones that are just exploring, I would say probably there's about 5, 6, 7 companies. Then the ones that are permitted and sort of close to production, that's very small. I'm going to say there's maybe 3, 4. Um, and then you've got others that are permitted, are producing only perhaps recently, um, are are very well positioned to grow that production, and also to continue exploring. And part of the reason they've gotten into production is that they don't have to keep going back to the market to raise money and issue shares. They can use the cash flow to go out and spend it on exploration and create value that way. And that's an even smaller number, probably 2 or 3, because I've got then the free letter. So that's Silver Advisor. And if anybody goes to Silver Advisor, you can see the companies there. I'll try to name them from memory. So we've got Aya Gold and Silver. That's a relatively large producer. They produce silver only out of Morocco. Then you've got Skeena Gold and Silver. They are a BC project, a large project that's going to produce a lot of silver once this mine comes online. I think that they're probably a matter of a year and a half away, perhaps, from production. Very well financed, very well run, very well advanced. And then you've got Kootenay Silver, that is an explorer in Mexico. They have a fantastic project that is very high grade silver. They're doing a lot of drilling, and it has become their flagship. It's called Columba, and partly like many of these companies, but partly owned and financed by Eric Sprott, who's been, sort of he's almost saved the junior mining industry, single-handedly over the last decade. And then, like all of us, not all of his investments turn out, but he's very savvy, very wise, and it's certainly a good sign when you see his name, as an investor on these corporate structures. We have a company that was most recently added called ES Gold. That's an interesting play. That is a remediation play. So what they're going to do is they have these stockpiles of ore, above ground ore. They have most of their equipment already on site. They're installing things. They have one sort of last piece of financing that they need to lock up. They expect to be in production at the end of the year. They're going to provide a revised preliminary economic assessment using more recent prices on metals, but this is going to be a true cash cow. Very, very, very profitable. And so it's going to produce sort of tens of millions of dollars likely of cash flow every year. And they're going to be able to turn around and plow a lot of that money back in. And they're in what we call a VMS district. Um, the mine itself that they own, and now will be treating the waste ore to remediate it. That mine alone has produced over $1.4 billion of metals over its, say, 100-year history. And so they have a big land package. It's all locked up. They're going to start exploring. They've already done some exploration using geophysics and so on. And so they're going to just roll that out and explore it bigger, over a wider package. But it's in a prolific district that has a lot of these types of deposits, and so it looks very positive. It's interesting too. Now, one that came to mind also I'm sorry, I'm talking very fast, but I want to get it all in. There's a company called Go Gold. So that's a Mexico play. They are like ES Gold. In fact, I consider ES Gold to be a little bit of a junior version of Go Gold. So Go Gold is more advanced. They have been producing through tailings remediation also, but in Mexico, in Parral, for several years already. And they produce silver, gold, some copper, and some base metals, lead and zinc. That brings them a fair bit of cash flow as well. It minimizes how much they have to go to market to raise money and issue shares. And they're waiting on a permit from Mexico. I think that's probably a matter of a few months away. They've got everything, submitted properly, and they're going to start once they have that. They're going to bring a very high grade mine in Mexico into production. It's probably about, oh, I'm going to say maybe, we're looking at maybe a year's construction, not too bad. And that's going to probably get a big re-rate as well.
So, Peter, the silver price appears to be artificially suppressed and usually part of, say, a buy gold, sell silver trade. However, Bank of America now says silver will go to 40 in 2025. Can you elaborate on why silver might now break out in the short term to medium term, and then what has changed or is changing as silver is usually just a byproduct? And while perhaps in structural deficit, it's unclear why the floor will be raised for silver price. Well, that's a very smart question.
Yeah, I mean, there's a lot in there, but what I'm going to say is that, I think that what's changed is that um, the market's realizing that and I talked about it before, these secondary supplies where big consumers of silver have been able to go and tap, just silver sitting there, buy it at the existing price, whatever that is, say $28 or $30, whatever it's been for the past year or couple of years. They've just been able to go and buy the silver that they need and, not put pressure on trying to get new silver to market. So if you think about it, there's these three sources of silver supply. There's silver that comes from mining. There's silver that comes from recycling. That's the billion ounces of let's say, new silver that's brought to market every year. And then the third source is these secondary supplies, silver that was produced in the past and has just sort of been stockpiled. And we know, I have the charts that show and prove this. This silver, these inventories have come down dramatically. I'm going to say probably to the tune of about 70%. And so last year, I was saying that we're maybe somewhere around 18 months from these identifiable silver supplies, secondary supplies running out. And then maybe a month or two after that, there was an interesting report from TD that was basically saying the exact same thing. And again, yes, there are other further supplies of silver beyond what we can measure on these exchanges and so on that are held privately. And people will argue, yes, well, that silver can come to market too and help supply any deficits. And I agree with that. However, and I'm not the only one who says this, I think that those supplies of silver will come to market, but only at much higher silver prices. And I'm talking about 40, 50, 60, $70 silver. And that's why I think silver is headed that much higher. I think that the market has really come has is now come to the that reckoning that we don't have all the silver that we need. It's out, there is a lot of it out there, but the holders of that silver are not going to be willing, for the most part, to let it go until the prices are a lot higher. So that's where we're headed.
This is totally just me, but I think was it today that Goldman Sachs announced that all the central banks actually have been buying a lot more gold than they
Yes.
said they so do we possibly think that's maybe necessarily also the same for silver
Well,
on that level?
yeah, possibly. It's not beyond the realm of assumption that there's a lot more silver being consumed than is sort of being reported. And I'll give you one example. Is essentially almost no data for silver being consumed by by the defense industry. And that's not an accident. I think they don't want us to really know how much silver they need. It's basically it's a critical metal for them. But I've come across some data, and we're talking about maybe as much as 5% or maybe even double that of the annual silver supply goes to the defense industry. It's in Tomahawk missiles. It's in, silver is a wonder metal in a sense. It's in all kinds of electronics. It's I like to say it's never more than a meter away from you because it's in your smartphone, it's in your flat screen TV and your iPad, it's in your keyboard, it's in your smartwatch, it's in your smartphone, it's in on-off switches. It's in everything. And so you can imagine that the defense industry has all this more and more computerized, sophisticated equipment, drones, you name it. And all of these things have, circuitry, have PC boards. Um, all that stuff uses silver. So, for them to say how much silver they consume would probably help the silver price to rise, making their acquisition of more silver more costly. So they're not interested in us knowing how much silver they need, and that's why I say that in different ways, but still comparatively to gold, I think we do have a similar situation that there is a lot more silver being consumed than is being reported.
What do you think? I know you just mentioned go gold, but what do you think of Mexico as a jurisdiction as well?
Yeah, I mean, people have been concerned, and I think to some extent rightly so, about Mexico. And I think that that has changed dramatically in the past probably 7 or 8 months. So the last administration was quite anti-mining, and I think that the new administration, that's Claudia Sheinbaum, who is the new president of Mexico, She's a pragmatist. She came in, she was the former mayor of Mexico City. She came in, she was elected, I think it was back in September. And the tone is totally different, much friendlier towards business in general. Mining is very important in Mexico, and the reception has been a lot warmer. And that's what I'm hearing, not only from the mining companies, but there have been several permits earlier this year that have already been issued. Those are the first permits in a long time, and they've actually, and not sure if I have this exactly right, but there was talk about potentially banning open pit mining in Mexico, and that would be a big deal. And that has apparently been completely erased from the government website, the idea of banning open pit mining. And so the thought is that it's just a matter of time before we see open pit mines being permitted again in Mexico. Some companies have shifted. Gold is one of them. They've been able to, thankfully for them, and this was a way to kind of move forward and minimize risk, and shifted to an underground model to mine their deposit. But I think, some projects don't have that luxury necessarily if they're lower grade and so on. But I believe we're going to see open pit permits being issued again, probably perhaps as early as this year, before the end of this year. And I think that's really going to be sort of the starting pistol again for mining in Mexico. But the tone has really changed. It's become a lot more favorable. People are a lot more open to Mexico for mining, and Mexico is the world's largest silver producer. It produces twice as much as the next producer, which arguably is either China or Peru. It kind of goes back and forth. But yeah, Mexico is very much crucial to silver, and it's nice to see that the tone changing back to much more favorable.
Another great question. Do you see a possibility for windfall taxes on silver miners later in the bull market? And could this be an incentive for better risk-adjusted returns in explorers and junior miners rather than the established producers?
I would say yes. I think everything's on the table. Something like that wouldn't surprise me. Blame the speculators, right? Like is so often the case. And I think that's terrible in a way, because what people don't realize is that um, as much as they're derided, speculators play an important role. They bring liquidity to markets, and that's something that people don't realize. And they take risks. They take risks with their own money. It doesn't always turn out. So, I mean, yeah, I think that's on the table. I certainly think, I hate to say it, but unfortunately, yes, it's on the table. And so, the more you can make from bigger, better returns, hopefully 10 baggers, hopefully 100 baggers and 1,000 baggers, like JP talked about yesterday. They're there. They're there to be had. And I think that is also a great argument for taking profits, because if I would assume that until something like that comes in terms of new laws and so on, um, unless it's retroactive, then profits you've taken before that kind of law would not be affected. But I think we're going to see some tremendous gains. I wouldn't let that discourage me. I'll end it by saying that.
Another great question. The World Gold Council is working towards issuing a physically backed digital token. Do you know if the Silver Institute might be looking at something similar for silver investors?
I haven't heard about anything like that. It would be interesting. Um, you know, I talk about that actually in the book. It's an idea that came to mind when I thought about what's money, and where are we going with all of this? And I want to say this much. People sometimes look at money and they think it's complicated, and they try to understand it, and they don't really get, that governments print money and what does that do and what are the effects and so on. But if you just boil money down to what it is, it's not complicated. Money for me is stored wealth. Really, that's all it is. It's stored effort and it's stored wealth. So the problem, though, with fiat money, so paper money, for example, or digital money, if it doesn't have uh, um, a cap in terms of how many units, outstanding units that you can have, if it's not considered hard money like gold or silver, then you know you could let's look at something. For example, you could have $100. You could have $100 bill that you got. Um, um, you know, say 80 years ago, 90 years ago or something. And that $100 bill back then would probably buy you, I'm going to say, 100 times what it could buy you today. If you were to, right? So if you were to take that $100 and you'd say, I'm just going to buy bread with it, or I'm just going to buy, I mean, that would buy you quite the load of bread back in, say 1925. Well, in 2025, that $100 might buy you, if you're lucky, I don't know, uh, if a loaf of bread is $4 or $5 today, you might get 20 loaves of bread, which, think about it, that's crazy. $100 is only going to get you 20 loaves of bread, whereas 100 years ago, it got you hundreds of loaves of bread. So that's the point, is that, someone who had $100 bill and held on to it for a century lost like 90 or 95 or 99% of their buying power. And yet, if they had an ounce of gold back then, and they held on to it today, I mean, you'd have at least the same buying power and potentially even more. So you're protected. So the whole point is that to me is real money, because if you had your savings, from work or from an inheritance or whatever it might be, and you had put it into gold, and for some reason you held on to it 100 years, you'd be able to buy the same quantity of things. You'd have protected your purchasing power, really, is what it comes down to. But the paper money would have lost almost all of its purchasing power. And so when I wrote the book, I taught, Bitcoin is a thing for sure, and I think if you compare it to pretty much all of the other cryptos, the difference with Bitcoin is, well, not only was it the first, but is that it has a hard cap. There can never be ever more than 21 million Bitcoins, and because it's in that sense hard money, you can't water it down by just printing more or producing more Bitcoins. That's why its value has gone up so much. And that's why I thought, in an ideal world, you don't want to be carrying around gold and silver to pay for things. You want, the comfortable, the easy, the practical, the fast crypto, right? And but you don't want crypto that where someone who's sort of runs that crypto can just go ahead and create more of it, because then the ones you own will lose value just like the paper money you have today. So I thought, let's say, other than Bitcoin, for example, the best other types of crypto would be coins or currencies, cryptocurrencies that would be backed by silver or backed by gold. Now, so I think that's where we're headed. I really do. I think that would be the ultimate form of money, frankly. And um, there are some things that need to be resolved, because there will inevitably, someone might solve this problem. And if they do, they're going to get very, very rich at it. But there's the issue of trust. So if you think about, for example, some entity issues silver-backed crypto or gold-backed crypto. The physical gold or silver that backs it has to be somewhere, and it has to sit somewhere, and you have to be confident that it's there, and you have to be confident that it will not be confiscated, will not disappear. et cetera, et cetera. So the day that you can get past that, let's say that obstacle, I feel that gold and silver backed crypto would be the ultimate forms of money because you have that hard asset that backs it. These are these are commodities that have been money. Silver has been money longer than gold. Silver's been money for 5,000 years. Gold's been money for arguably maybe 2,500 years. So these are the ultimate forms of money. But if you can marry them with crypto and you have all the benefits of the technology, the portability, the speed for transactions, and all of that, then that's when you have the ultimate and the best form of money. There are some important things to, wrinkles to iron out first.
That is a great answer. Another great question. Most mined silver is byproduct from mining other usually base metals. Are there any of those mines coming to the end of their lives over the next few years that might potentially reduce the supply of silver?
Yes, I mean, I don't have that data off the top of my head, but I have certainly come across that pretty regularly. And for sure, only about 25% of silver produced mined silver comes from what we call primary silver mines. 75% of mined silver is a byproduct. So it's mines that will produce gold, copper, lead, and zinc typically that will also produce silver. So think about that. Three-quarters of all silver that comes from mining every year comes from other kinds of mines, not even silver mines. It's just that the silver comes along with the other metals. So silver is at the mercy of producing these other metals. And yes, there are plenty of large mines that are mostly base metal mines, copper, lead, zinc mines that we can't get enough copper, and arguably we can't get enough zinc potentially either. And so copper, I think, more than anything is the big one. And we're running out of it. And for the most part, different jurisdictions and governments are not that friendly to providing new mine permits and so on. So a lot of silver will depend on continuing to mine these other metals, and they're becoming relatively more scarce. So it's going to be very interesting to see how that plays out. The one place that we've seen actually more silver as byproduct has been from gold over the past year, and gold production has gone up a little bit, and so the silver that's come out of those gold mines has helped boost a little bit of more silver from mining, but only from the gold sector. And I think the reason for that is because the gold price has been so high, consumption has been so high. So you've seen gold miners sort of crank it up a bit and try to produce more gold, and by accident almost, or as a byproduct, they're producing this more silver, but it's almost insignificant.
We actually kind of have a question about gold, so since that kind of brought it up, I feel like we'll go with it. Um,
Sure.
Slightly off topic to ask, but gold, curious about your take on what we've seen recently. For decades, gold and the US dollar have maintained a generally inverse relationship, yet, parts of 2024 and 2025. The correlation has appeared to break down. In your view,
Right.
like, is this a meaningful signal of a structural shift, or do you just think that's a short term? We don't know.
Yeah, I mean, it's what I'm going to say is that you get both. You get periods where they do move inversely. Typically, if you look on very, very short time frames, we're talking days or weeks, then they do very typically move inversely. But when you look over longer time frames, you can have any kind of combination. You can have gold moving up and the dollar moving up. You can have both of them moving down, and you can have them moving in opposite directions. So it really almost depends what phase you happen to be in. Like I said in my presentation, I do think that we're heading into a longer term bear market scenario for the dollar. Uh, and separate from that, I think we're moving into a long term bull market for the metals. the weaker dollar, if it plays out the way I expect, is just going to be helpful to higher metals prices, gold and silver prices.
All right, we have a few more questions, but I think we should give away a book right now because there's 20 questions in the chat, and so I don't want it to
All
become
right.
so large. So, Peter, think of a number between 1 and 20, and we're going to pick that number, and that person's going to win.
Okay, let's go with 16.
All right. Oh my gosh. Well, while I'm counting, we've had a few questions about China. Do you want to answer this? Do you think China is manipulating the silver price down in effort to lower input costs of solar panels and other industrial goods?
You know what? Honestly, no, I don't think so. I'll tell you why. One is because, first, anything's possible. So that's my disclaimer, right? Anything could be. But my gut tells me no because two reasons. One is that they have the Shanghai Futures Exchange, and that is a physically backed exchange. And a lot of gold and silver goes through that exchange, and it's meant for delivery compared to so that means that people who buy futures contracts and want to take delivery are very likely to not have any problem and have the silver available there and take delivery if they want it. That's not the case for the LBMA and then the COMEX in New York. So the vast majority of silver futures being traded there never take delivery. So um, on that, that's one reason I don't think that China's necessarily manipulating the silver price downwards. The other reason is because silver consumers in China, and this I've been told by one big silver producer that sells half of their production to China and the other half to the West, has told me, in confidence that their silver buyers out of China are coming to them and saying, "We are willing to pay you up to $2 above spot price, and we're willing to pay you 2 weeks in advance of delivery." So that means they're willing to pay more than the spot price, meaning that they would technically be helping to push the price up by doing that. So for those two reasons, that's the insight that I have. I don't think that they're manipulating the silver price downwards.
All right. So Adrian, I just typed in the chat. You are number 16, so you won the Q&A one. We're gonna get to a couple more questions in here, and then we'll also announce a winner in the chat as well. Peter, the Shanghai Future Exchange is opening its doors for Western business, giving investors and brokers direct access to China's gold and silver futures. Commodity pricing power appears to be shifting from west to east. Moreover, the COMEX appears to be dying with this backdrop. How do you see this playing out for silver as China starts taking the lead in pricing power? I know that kind of relates to our last one, but
Yeah, it does. Yeah, I mean, I think that I agree with that the pricing power is moving east. That's where there's consumption, frankly. And in that sense, they deserve to determine pricing. And that kind of goes back to my answer from before. The big consumers in China naturally would not want the silver price too high because it affects the cost of their products. But nonetheless, I think that just based on how, and I'm certainly not an expert, but based on what I know of how the Shanghai Futures Exchange works, and that its goal is to, have metal for delivery. It's more of a true, I think, transparent type of market, and opening up to the rest of the world, I think, is just going to be quite detrimental to these other established exchanges. And frankly, I think, that kind of move is smart, and the business they get from it is deserved. It's a shame we don't have those kinds of markets here in the West where we, sort of bully around and try to give the impression that we're the financiers of the world, and that we run the finance markets, and everyone should look to us. I think that we're if that's how some people in the West feel, I think that they're misguided. I think that that we will see that shift, and like I say, a lot of it is due to consumption.
We have another question that pretty relevant from was it this week or last week? The Florida bill that Ron DeSantis published, making gold and silver legal tender. Like, do you think, I guess, other states are going to follow that? Like, what will be the impact, I guess, of that?
Right. Um, So it wouldn't surprise me. I mean, in fact, in the book too, I wrote about the Sound Money Defense League, which is, I think, a tremendous organization. And so what they do is, and this is a non-profit kind of thing. It's fully privately funded. What they do is they go around and they basically lobby different states to remove. It's somewhat related, but they remove taxes from gold and silver. And so their argument is this is not um, how can I put it? It's not a speculation. It's in some ways perhaps not even an investment. It's a form of bu- of protection of buying power. It's actual money, right? I'm just buying money. How can you tax cash, so to speak, right? And so they're going around to different states and they're lobbying them and they're trying to get them to remove taxes from gold and silver, purchases. And some states are more open-minded and they are moving towards that. Some have done it, and um, it's just, it's I think it's the way of the future. It's the way it's going to go. And I think that this move by DeSantis uh, is, first of all, he says, that it's in the Constitution. It's constitutionally, I guess you could say either mandated or, allowed, so to speak. And it's hard to know. I'm going to be honest. It's hard to know what the impact will be. What I do think is that as inflation gets worse, what you will have more and more people say, hey, we've got this contract between us. I'm not interested in settling it in fiat currency because it's losing buying power. I want something that's more stable, more predictable, and I want to have this agreement settle, have the option to settle this agreement in gold or silver. And so I think we're going to start to see more and more states trend towards that. It's I think in some ways kind of a big one because Florida is a big state population wise. Um, and so yeah, I think it's pretty it's a pretty big milestone. We're going to see more of that happen. Again, hard to say what the sort of other implications are. I think it's also going to just draw more and more attention to this space, and more people will become gold and silver investors and holders.
P from yesterday sent a question. Given your purchasing power analogy with bread, we used to say that 1 ounce of gold or 20 ounces of silver would buy you a fine dinner at the Savoy Hotel in London. I'm sorry if I'm pronouncing that wrong.
Yeah, sure. The
Given
Savoy, I think.
given that ratio and looking at the menu of Savoy, do you think silver should be worth 150 US now?
So JP, thanks for that question. And I don't know, JP, I haven't been for supper at the Savoy lately. Maybe JP has, but I'd like to, if he's inviting, I'm in. But what I will say is that silver should be a lot higher. There's no doubt about that in my mind. And I'll say this. When I wrote the book, I put in there my ultimate price target for silver in this bull cycle. Within the whatever it takes, 5 years, 10 years to play out, I think that silver will ultimately, at least in the mania phase, reach a $300 level. Now, I can tell you that a lot of people were, saying ridiculous, crazy, blah, 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 on and on when I started saying that, 3 years ago or so, maybe even a little bit before 3 years ago. Now I'm hearing very, very well respected pundits and analysts in this space calling for $500 silver. So now I'm looking like the conservative one. And if you, and, frankly, in the book, I didn't pull this $300 number out of a hat. What I did was I looked at different indicators. I looked at the gold silver ratio back in 1980 when silver hit $50 and gold was 850. And that ratio bottomed around 14 or 15. Then I looked at things like the average home price in the US to the silver price ratio, again in 1980. I looked at the Dow to silver ratio, the S&P to silver ratio. I looked at about 4 or 5 different ratios. And of course, you can't help it. You've got to make certain assumptions. And one of my big assumptions, and again, looked crazy several years ago, a lot less today, but was that gold would reach about $5,000, per ounce US, at least, when it eventually peaks. I frankly think today we're going to probably get somewhere closer to about $10,000 US. But if you take a $5,000 gold price and you take the bottom of the ratio of gold to silver in 1980, let's say that's 15 to 1. That would bring you today to a $333 silver. If you look at the average home price in the US and the bottom of the ratio, I don't remember what that number is. I think it took something like 1,400 ounces of silver to buy the average US home in 1980. If you went with the current price of the average US home, which is I think about $500,000 US, and you applied the same ratio, you again get somewhere around $300. So I looked at all these ratios, 4 or 5 different ratios, each time with what I thought were reasonable assumptions for the other asset on the other side of the ratio. I came to around $300. So to me, I don't know, maybe it was a sign. I said I'm not going to say something ridiculous and specific like $332 or $292. We're making big guesses at this point, and I think a big round number is probably as good as any. And $300 was what I came to over and over. So I think that, JP saying $150 is very reasonable. And if you take the current gold price, let's say just for ease of calculation, and you say, $3,000 and you divide it by 15, you should be at $200 today in silver. So for sure, 100, 150, I think. I'll give you one sort of little anecdote. And I know he's a silver bull, a big silver bull, but this guy, Tom Kaplan. Tom Kaplan is an uber successful commodities investor and a very big silver bull. And I had the chance to meet him in New York last fall in October at a silver conference. And, went up to him, talked to him, uh, gave him a copy of my book. And he said, "Oh, I've seen that. I know that." And I said, "Well, where do you see silver going in this cycle?" And he said, "Double digits easily." So, the lowest, sorry, triple digits. Um, he said triple digits easily. So as we know, the lowest triple digit you can have is $100. And so I think that I completely agree with that. We're going to see at least $100 and probably even a multiple of that.
Well, that is a great way to end this. I feel like we answered nearly all the questions. If we didn't, I apologize. I don't want to keep Peter here all day.
All right. So again, I'm pretty active on Twitter, so that's at Peter_Krauth. I'm on LinkedIn. You'll find me there as well. The newsletter is silverstockinvestor.com. The free letter is Silver Advisor. And if you Google those, you'll find them no problem. And hope to count you as a subscriber sometime soon. This is, like I say here, a generational bull market, and I think, so I liked one great quote, I think, would be from Doug Casey. Some of your viewers may know, some may not, but He's a true speculator that's been around this space for decades. And what he said about silver equities is that when the crowd gets interested, and I'm paraphrasing here, it's like trying to siphon the contents of Hoover Dam through a garden hose. There are just so many names they can invest in, and the rising tide will lift all boats, and the silver space will just return tremendous, provide tremendous returns for investors.